Greetings to my dear lecturer. My name is Suvitra Murgayah, metric number 264514. Today I am going to present case 5 titled Should Pfizer Acquire Allergen? There are three problem statements in this case. Number 1. Does merging with Allergen brings benefits to Pfizer? Should Pfizer merge with Allergen? Number 2. Does the tax planning in the case help to resolve the issue? Number 3. Is tax inversion legal and ethical? For the problem statement number 1, does merging with Allergen brings benefits to Pfizer and should Pfizer merge with Allergen? I have used cost-benefit analysis to do this. A cost-benefit analysis is a systematic process that businesses use to analyze which decision to make and which to forego. An analyst or project manager should apply a monetary measurement to all of the items on the cost-benefit list, taking special care not to underestimate costs or overestimate benefits. Finally, the results of the aggregate costs and benefits should be compared quantitatively to determine if the benefits outweigh the costs. If so, then the rational decision is to go forward with the project. If not, the business should review the project to see if it can make adjustment to either increase benefits or decrease costs to make the project viable. Otherwise, the company should likely avoid the project. In this case, merging Pfizer and Allergen would cost $152 billion, and their breakup clause is $400 million. Pfizer and Allergen merged company would retain to its administrative headquarters in New York for tax purposes. It would be a resident of Ireland. Most of the financial benefits of the merger would come from lowering tax rates on Pfizer international operations. By relocating its tax resident to Ireland, Pfizer's worldwide tax rate was estimated to drop from 25% to 18% in the first year alone. Pfizer would also obtain all of Allergen's future revenues and profits. The combined revenue and profits of the merged company were expected to total $68 billion and $21 billion respectively. And before merging, if you could see here, it is the revenue before merging is $62,667 million USD, and before merging for profit is USD 7505 million USD. Lastly, the tax savings would also greatly reduce costs to repatriate the $74 billion in overseas cash holdings that Pfizer had accumulated. However, it is the tax residency will move to Ireland. Pfizer would pay 12.5% instead of 40% to repatriate these funds, potentially freeing up the cash for the other uses. But, after the regulations that have been implemented, additional Treasury actions to rein in corporate tax inversions, it was claimed that it has great disadvantages. This tax has a higher corporate tax rate. The Pfizer and Allergen company merged because the companies wanted to save tax, but this seemed to be a great disadvantage, where the costs are higher than the benefits. Thus, it is not advisable for Pfizer and Allergen to merge. Problem number 2 is, does the tax planning in the case help to resolve the issue? The tax planning that have been used is transfer pricing. Transfer pricing is an accounting and taxation practice that allows for pricing transactions internally within businesses and between subsidiaries that operate under common control or ownership. The transfer pricing practice extends to cross-border transactions as well as domestic ones. The transfer pricing is used to determine the cost to charge another division, subsidiary or holding company for service rendered. Typically, the transfer prices are reflective of the going market for the good and services. Transfer pricing can also be applied to intellectual property such as research, patents, and royalties. Multinational companies are legally allowed to use the transfer pricing method for allocating earnings among their various subsidiary and affiliate companies that are part of the parent organizations. However, companies at times can also misuse this practice by altering their taxable income, thus reducing their overall taxes. The transfer pricing mechanism is a way that companies can shift tax liabilities to low-cost tax jurisdictions. In short, by charging above or below the market price, companies can use transfer pricing to transfer profits and costs to other divisions internally to reduce their tax burdens. Followed by the case, tax planning through means such as transfer pricing was often used to companies such as Pfizer to lower their effective tax rate. Pfizer's effective tax rate was approximately 25%, despite facing a US marginal tax rate of 40%. However, this was still higher than the effective tax rate of its competitors with international tax residence, such as GlaxoSmithKline plc of Britain 5%, Novartis of AG of Switzerland 12.5%, and Allergen of Ireland 5%. Pfizer's CEO noted that the cash used to pay taxes was money that could not be used to fund acquisitions or share buybacks, disadvantaging Pfizer's relative to its competitors. Nevertheless, Pfizer's effective tax rate was similar to US resident peers such as Merck & Co., which is 30%. However, there was one issue that was found, which means if they merge, and since the Ireland has the tax authority, they will be charging low rate. But once they want to bring it back to US, the profit will be taxed with higher rate. So that is one disadvantage. And our main motive of this case is to lower the tax rate. And this again is higher the tax rate, which is not advisable to continue. And this is not helping to solve the issue. Problem 3. Is tax inversion legal and ethical? A tax inversion or corporate tax inversion is a form of tax avoidance where a corporate restructures so that the current parent is replaced by a foreign parent and the original parent company becomes a subsidiary of the foreign parent, thus moving its tax residence to the foreign country. Executives and operational headquarters can stay in the original country. The US definition requires that the original shareholders remain a majority control of the post-inverted company. As such, since tax inversions are legal and also ethical, moreover, inversions often lead to fewer jobs in the US as jobs are transferred overseas as a result of the combining of a US corporation with a foreign corporation and the shifting of a corporate headquarters overseas. Tax inversion, which was accomplished by merging with a company that was already resident of a low-rate tax country and then using a lower tax country as a tax resident for the combined entity. When this occurred, the newly merged entity was no longer required to pay US tax rates on the profits earned outside the US. Consequently, tax inversions had the potential to reduce taxes both on the future profits that would be earned after the merger and on cash stockpiles that had already been earned but that were being held offshore to avoid triggering repatriation taxes. U.S. Treasury new rules titled Additional Treasury Actions to Rein in Corporate Tax Inversions. These measures appear directly target proposed tax inversions by reducing the ability of firms to move their tax domicile into countries where they had little economic activities, particularly when merging with smaller firms. After reviewing the changes, both legal teams were confident that the rules would not interfere with the proposed deal because Allegiant shareholders would own more than 40% of the combined company. Saunders put it well when he said, "We built this deal around the law and regulations, all the notices that were put out by the US Treasury, and it was a highly legal construct." So it is since it's legal, it is ethical as well. That's all from me. Thank you.